Good afternoon, everyone. Thanks for joining us today for an update on NEPC's outlook and our observations on markets. As many of you know, we for many years have done a January webinar trying to update clients on our views and our assumption setting process, and then spend those first few months of the year going through those views with clients, working with you to make decisions around your portfolio where there might be some opportunities for changes. And we've realized that we are looking at markets constantly. And while we do our best to inform clients throughout the year, we thought there was the opportunity to do that on a more regular basis through a format like this. So we're excited to start a quarterly webinar series and make sure that you're hearing from all the strong resources that we have internally. So today, I'll provide a brief market update, and then we'll have some of our best and brightest professionals from the research team providing updates on various beta groups. And I think that's the other important thing that we want to keep reinforcing with clients, this idea of portfolio construction through a beta group lens. So today we have Tim O'Connell, a consultant on our traditional research team and leader of our equity beta group, bringing together the thoughts from long-only equities, equity long-short, and private equity to bring our best views on equity beta and the best way to get exposure. We have Dulari Pancholi, a senior consultant on our hedge fund team and recently named principal of the firm, recognizing her leadership and impact on NEPC and our clients. She leads our credit beta group efforts and will provide an update on credit markets. And then Matt Ritter, a consultant on our real assets team and one of the leaders of our real assets beta group, will provide an update on real assets. And then hopefully we'll have some time for questions at the end. And so if we flip ahead a couple slides, I'm just going to spend a minute on our market outlook. You can see at a very high level, I think a couple things jump out here. First, if you look at the direction and colors of the arrows, you see a very mixed story for the quarter. You look at equities, emerging market equities ended up a little bit, US and developed international markets down a little bit. And that story is pretty consistent across the board. Credit markets were down a little with rising rates, real assets somewhat mixed. And I think the other part of this is how range bound most markets were. Certainly it's mixed and we had some increased volatility, but point to point, you look at most of those markets and they're up within 2 percentage points or down within 2 percentage points. And I think that masks a real shift in the environment that we saw this quarter, and that was the return of volatility. And while that was concerning for investors and concerning for markets, the story here is not that that was unique. It's how unique the year before that was, 2017 leading into 2018. The vol was profoundly low. And we didn't think that that would continue. We didn't know that it would necessarily change right away in January, but we did expect at some point that volatility would come back. And we did see the return of volatility, first at the end of January, with some concerns around inflation and also some technical trading pressures on volatility markets. We then saw that subside very quickly. And then towards the end of the first quarter, into the second quarter, we saw a reemergence of volatility, this time more around trade wars and concerns around tariffs and other issues that might be rising in markets. And I think a great way to think about that is not so much the events and their impact on volatility, but tying them back to key market themes. Many of you have heard our key market themes and why we think this is a great lens to think about portfolios and the macro environment. Really, it's a way of thinking about the pressures and factors that are driving market pricing, not just one particular market, but capital markets broadly. To the extent that they play out as expected or better, that's very beneficial for markets. And we saw that in 2017 as many of the themes that we observed played out more positively than priced in. And what we're seeing this year is some volatility around some of these themes. We do think that the US economic cycle can continue. We've seen global economic resurgence. We've seen the rest of the world come along for the ride with the US. We think the Fed will continue to be gradual, and global central banks will continue to be gradual. We expect a continued moderate transition from China on many different levels, economically, from a societal perspective, from a monetary perspective. And then we expect more pressures around globalization backlash. And I think two of these themes really explain the volatility that we saw, and that's Federal Reserve gradualism and the globalization backlash theme. So I'll spend just a couple minutes on those. We saw in the first quarter an increase in inflation, particularly in January. And if we take a longer term perspective going back 3 years, going back to 2015, we have seen a tremendous increase in inflation from the lows of zero back up over a 3-year period to more moderate inflation. That's a tremendous increase. I think it's important to not just focus on the change, also on the levels. And the level is still pretty moderate at between 2 and 2.5%. I don't think this is something that's concerning to the Fed at this point. And I think if you look at that 2018 observation, where the market in January started to get concerned about inflation, you can see it is an uptick, but it's a very moderate uptick. And it's one that we think the market can absorb and that the economy can absorb. And when we look bigger picture, certainly we've seen a rate increase from the Fed in 2018. But when we look out longer term, we still think that the market and that the Fed and other global central banks will be very gradual in their approach. When we think about the theme of Federal Reserve gradualism, it's about much more than will the Fed raise rates or won't they? It's about the process that they follow and the communication that they deliver around rate hikes and how the market absorbs those. So yes, the Fed is expecting a few more rate hikes this year, and the market is expecting about 3 more rate hikes this year. Certainly further out, we have concerns that the Fed is talking about several rate hikes beyond that, and the market is not pricing that in right now. And I think that's a disconnect that has to get resolved. But when we look big picture, we see that the expectations of rate hikes out into the future are still very moderate, still very favorable for risk assets, for market pricing generally. And we think that the Fed and other central banks understand how delicate the balance is and will be very deliberate in anything that they do, to the extent that they can be deliberate. I think the concern would be if inflation does really spike and they have to battle that, that would be a disruption to that Federal Reserve gradualism theme. The other theme that we saw have some volatility in the first quarter is the globalization backlash theme. This is a theme that we've talked about for several years, and we've seen manifest itself in 2016 and 2017 through the political realm. We saw the Brexit vote and the US presidential election in 2016. And certainly coming into 2017, we had concerns about elections in Europe. We saw those play out towards convention with centrist candidates getting elected, and the fear of globalization backlash for markets subsided quite a bit, and that was favorable for market performance. What we've seen this year is a new manifestation of the globalization backlash theme. It's through trade wars. You saw the size of the China and U.S. trade balance certainly tilted towards China, with a $375 billion trade imbalance towards China, or in favor of China. Just for perspective, just how profound that has become. In 1979, trade between the U.S. and China was $2 billion. In 2017, it was $636 billion. So that gives you a sense of how much that has grown and how powerful it is, the linkage between the two nations. And so I won't go through the details here of all that's happened so far this year. We've all seen it in the headlines. We've seen tariffs issued by the U.S., a response from China, and some grandstanding so far this year. And I think it's more important to look forward and think about what this might mean for the future. To the extent that we have a resolution and or even a revised trade agreement, I think certainty is the key, and some form of stability is necessary for the markets to move forward. And if that happens, I think that's very favorable for markets, even if it's something different than what we have today. To the extent that we get something different, that we see an escalation in some of these tariffs and we see a full-blown trade war between the US and China, that could be really disruptive. That could prompt inflation. It could lead to a decline in growth. And further, to the extent that some of these tariffs pull other nations in, it could lead to a global trade war, and that would be a real challenge for global markets to work through. And it's something that it's a tail risk at this point. It's certainly not our base case, but it's something that we're watching closely. And so if we flip for a second from those themes, what that means for current opportunities, many of the opportunities that we talked about in January are still in place. We still think trimming US equity gains and tilting to international markets makes sense. We still like tips over core bonds to provide some inflation protection. We still think that credit markets look more overvalued than equity markets, and shifting to some safety in your fixed income allocation makes sense. And we still like diversifying assets like macro hedge funds and long volatility exposure with positive carry. We do have a new theme, and that's our new opportunity rather, and that's taking a close look at MLPs, master limited partnerships. This is a market that was down 10% in the first quarter, which seems to be pretty disconnected, given that this is really energy infrastructure. You saw on the first slide, oil was up 7.5%. It's a market that's down 20% over the last year. So it's seen a big correction. If we just look from a yield perspective, you can see that the potential yield here from these assets is really strong, and something that we think is worth considering. There are some tax advantages to these structures for taxable investors as well. So it's something that we're looking at closely. I think it makes sense for investors that can absorb a lot of volatility. It's a market that, as I said, was down 20% last year. And we think we'll continue to have a lot of volatility, but might have some pricing opportunity here. So I think Matt will spend a little bit more time on that when he talks about real assets. So that's our high level market overview. I think at this point, I'll turn it to Tim O'Connell to talk about equities.
Thank you, Tim. Before I jump into equities, just to point out that if you'd like to ask questions throughout, we'll do question and answer at the end, but feel free to use the box on the lower right to write your questions. Thank you. Looking at the first quarter, the U.S. markets declined 80 basis points and saw their first negative quarter in over 2 years. Information technology was one of the bright spots, both here in the U.S. and globally. And particularly non-U.S. equities, we saw emerging markets, as Tim mentioned earlier, one of the few areas globally that had positive returns, with the other outlier being the international or EFI hedged, which is a currency hedged version of the EFI, which the hedging in the U.S. dollar detracted. So if we take a forward look here towards our NEPC Equity Beta Group's views, you'll hear these common themes throughout our slides. We talked a little bit about U.S. equities and elevated valuations. And so you'll see later that we talk a little bit more about implementation outside the U.S., whether that's in large caps or small caps. We continue to see strong earnings in Europe, as well as emerging market divergence. And so you'll see us talk a little bit about active management throughout the year in emerging markets because of the divergent economies globally. And so our recommendations or our actions, trimming U.S. equities, maybe recycling some of those gains that we've had for a strong bull run of 9 years towards non-U.S. And that can be done either through global equity implementation or moving to a non-U.S. allocation. And then our preferred implementation options are going to be small caps, mostly internationally, and emerging markets, where we think we can access some of those more consumer or consumption themes, particularly in emerging markets. So I talked a little bit about valuations. So we have a chart here that tries to look at the U.S., the international small cap markets relative to their own averages. So a value of 1 means that the S&P, for instance, would be trading in line with its long run average for a price to earnings. And so what you can see here is the blue line, which is the S&P, is trading almost 1.3 times its average, whereas the EFI, which is in red, which is the area we're recommending clients reallocate some of those US dollars, is trading back in line at about 1 time, so in line with its long run average. And we think positive fundamentals in this market actually might make this less or more attractive, a little bit cheaper than it would appear on this page. Talking a little bit about earnings, we've talked about the recovery in Europe and Japan, which are kind of 2 of the largest parts of the international market. And what you'll see here is a nice step up function starting in late 2016 in red, where we're starting to see a stronger earnings recovery. And if we toggle back to the previous slide, we'll see that sharp drop down in red shows that earnings were increasing quite sharply, whereas price didn't quite keep up with it. So we do think that fundamentals on a go-forward basis do look attractive in the non-US markets. And last year, this is our overview slide where we look across public and private markets. If we look at the Q1 2018, international, particularly implementation through small caps, is a strong positive for us. We're positive generally global equity implementation. As I said earlier, the idea of taking some US dollars and potentially moving them away from the US. And then on the private side, we continue to be positive on private equity in Asia, as well as the flexibility special situation strategies provide. So with that, I'll hand it over to Dilari to cover credit.
Thank you, Tim. So for the first quarter, and I'll follow the similar pattern that Tim did, going over the quarter, then talking about a little bit about the fundamentals, how we view it, some action items, and finally kind of our view across the space in the credit landscape. So for the first quarter, given that there was a slight spike in vol, so to say, the credit spreads did widen out a little bit, but even with that, they still remain under the median, long-term median, and high yield still remains a concern for us. We think that future risk-adjusted returns, especially for high yield, is not justified by the yield that you're getting right now. Similar to equity, we do have our high-level thoughts here on the credit market. We think that credit is extremely rich. There's limited upside based on fundamental valuation. Risk premiums and defaults have remained low for a long time now. So we do think that credit selection is very important going forward. Emerging markets do offer some opportunity. At the same time, we remain concerned about the U.S. high yield segment. So given that background, the action items that we thought to highlight here today, the most important ones are reduce your passive high yield exposure. We are not getting compensated to take risk in that segment. Consider funding emerging market local currency debt using the risk from the high yield exposure if possible. And finally, consider options in private credit landscape if you can use the illiquidity in your portfolio. This is a quick snapshot of what it would take today to earn 5% yield. Pre-2008, if we allocated to just simply AAA securities, we would get 5%. Today, you have to dip way below and take some credit risk as far as single B. So markets have kind of shrunk. The spreads have tightened to a point where you don't get any yield unless you assume some level of credit risk in your portfolio. This is the same depiction, view of last 8 years. Where have the spreads gone, except for CCC energy, rated debt. Everything else has, kind of come down drastically. Even the energy spreads have come down pretty drastically. Everything is pretty much below the median. In the emerging market, though, we do think that there is an opportunity. There's a wide dispersion in terms of your yield. Real rates are still attractive, although we do admit that there's some headwinds in FX. But if we look at the funds that you have, you do have the option of diversifying, and that offers some value in terms of earning the returns. Structured credit is the third leg of our credit segment, and we do think that within structured credit specifically, CLOs do offer a relatively higher spread. And when we say CLO, we do mean the lower tranches, the equity and the mezz debt. When you compare it to a straight up high yield debt, CLOs would offer you a much better spread option in the portfolio. And this is our view. So, to just take a quick step back, we divide our credit group in three main segments: corporate credit, which mainly speaks to developed market credit, emerging market credit, and finally the third would be structured credit. As you can see, we have moved around a little bit in our views across the segment, but within corporate credit, one thing that we have remained constant on since a year now is our negative sentiment on high yield market. We are strongly recommending to reduce your passive long only exposure there. Consider funding other riskier assets, emerging market, local, or if you can afford the liquidity, go into private credit options. We do have a panel during our client conference that is going to explore further opportunities in the private credit segment called niche lending. That is another area to explore. But private credit is something we are positive on the corporate side, purely because we think that there is some aspect to credit selection that can benefit the higher yielding options that we need in the portfolio. Emerging market credit, we have remained positive on the emerging market local. We think the real rates are attractive. FX is a headwind, but diversifying across different countries can mitigate that risk to a certain point. We do think that the emerging market hard currency products may be slightly negative given that the US denominated debt spreads have come down. And finally, structured credit, we remain positive on CLOs. The spreads on the equity and the mezz debt is a significant uptick relative to other aspects in the credit segment. We are negative on CMBS, that's commercial mortgage-backed securities, primarily because of its exposure to the stress in the retail sector, but sometimes that does give an opportunity to some of the structured credit funds to leg into that space. So this is our high-level view. If you have any questions, feel free to type it in and we can address them. With that, I'll hand it over to Matt.
Great. Thanks, Dilari. Moving on to real assets, I'm going to follow a similar format to both Tim and Dilari and start by looking back at the first quarter. I'm going to focus on the chart on the top right here. Tim talked earlier about volatility picking up, and I think what happened in the real asset markets was in line with what you'd expect in an increasing volatility market. That is, gold and oil ticked up a little bit higher, though commodities overall were about flat. But more importantly, the equity markets sold off due in some part to fund flows out of broader equity markets. MLPs were the worst performing sector, posting double-digit losses. However, what you don't see on this chart is that in April, month to date so far, MLPs are up about 7%. REITs slipped a little bit and are now trading at double-digit discounts to their implied net asset value, which implies a slight disconnect in valuations between the private core markets and the publicly traded REIT markets. A few high-level themes. Real estate asset appreciation is slowing, which is leading to a slowdown in core real estate returns. We're continuing to see strong opportunities in private energy, both on the equity and credit side. We think the outlook for commodity-linked sectors, including mining and other natural resources, are beginning to improve. In terms of some actions, we like to focus on income growth and durability, given that we are a little bit later stages of an expansion cycle. And as Tim alluded to earlier, midstream MLPs and natural resources are potentially attractive places to invest within liquid real assets. However, it is important to keep in mind what your objectives are. Real assets can play different roles in a portfolio, whether it's total return, income generation, inflation hedging. Those types of objectives will determine what types of assets or investment styles make sense, as well as considerations such as tax status or liquidity. The first theme I'm going to focus on is core real estate. As I mentioned earlier, appreciation is slowing. Real estate returns are comprised of really two components. You have income and appreciation. Income, as the name would imply, is the distributable income coming off of the underlying assets in the form of rent payments, while appreciation is the change in asset values over time. What this chart shows is just the appreciation portion of that return on an unlevered basis. The blue dotted line represents the average since the market turned positive. So really the bull market to date, which was second quarter of 2010, while the dotted red line is the long-term 15-year average, which captures, cross-market cycles. As you can see, appreciation is still positive, but it has slowed dramatically, and in the last couple of quarters has been below the 15-year average. While part of this is due to an increase in interest rates or earlier on a fear of expected increase in interest rates, we are also seeing a slowdown in NOI growth, or a slowdown in the growth of the net income of the underlying properties. As a result, we're projecting core real estate returns over the medium term, 5 to 7 years, to normalize into the mid-single digits. While that type of return profile may be okay for some investors, we encourage clients to consider adding core plus real estate to their portfolio. Importantly, this is not a wholesale sell signal on core real estate. It's simply considering a consideration to rebalance. Like core real estate, core plus is intended to be fairly stable with an emphasis on income and is generally structured as open-ended vehicles. But we believe that core plus can potentially add an incremental 200 to 300 basis points of return over core real estate. Managers can do this by focusing on core-like assets, that is, typically larger assets in prime locations, but with a bit more execution risk. And what I mean by that, it could be things like near-term vacancies, or perhaps what investors call tired assets. Properties that maybe need, a new lobby, some exterior maintenance done, fairly light value add. But importantly, these are the types of assets that most core funds don't want to own because they imply a little bit less stability. By executing on these business plans, core plus managers have an opportunity to generate NOI growth or net income growth that is above the market average, which is what you generally would expect to achieve in a core fund. Core plus funds may also have increased leverage, but still at a fairly conservative level. So we think it has the potential to add some return to the portfolio. There is, of course, a slight increase in the risk profile, but we think it's still appropriate for that similar core real estate type of bucket. Switching gears from real estate to MLPs, capital has been flowing out of the MLP space. This graph shows total fund flows, including both institutional and retail investors. Retail had been somewhat negative for a while, but in February, which is what this chart shows data through, in February, the institutional flows turned negative for the first time since 2015. This is partially sentiment-driven, but also likely due a little bit to the volatility in the equity markets. However, we do think that there is an opportunity in midstream equities or MLPs. As Tim McCusker mentioned earlier, and he had a chart showing dividend yields, they are for MLPs over 8%, compared with about 4% for REITs and about 2% for the S&P 500. So I think the dividend yield can be attractive. In addition, you have the potential for multiple expansion. So in an environment where a lot of asset classes are trading at well above their long-term price to equity or price to earnings or price to EBITDA multiples, MLPs, as you can see on this chart here, are actually trading well below the long-term average price to EBITDA. So as sentiment improves, there's the possibility of multiple expansion. That presents a nice backdrop, but some more important things are growth in the U.S. energy industry overall and the improving balance sheets of MLPs. So U.S. energy production growth should result in high growth potential for MLPs that own well-located, higher quality assets. For example, there's one projection that estimates about $25 billion in annual energy infrastructure projects needed to handle the growth in U.S. energy production volumes. That's annual through the next 15 or so years. In terms of balance sheet and fundamentals, there were some bankruptcies earlier in the cycle, and certainly, that helped some companies get rid of debt. But even the healthier companies, you're seeing management teams continue to actively decrease their debt burdens and focus on improving their EBITDA margins, which we're seeing across the board. The last thing on here is corporate governance. I won't spend too much time on this, but essentially a lot of MLPs are improving the alignment of interests between the management teams and common shareholders. However, as Tim mentioned earlier, there are some tax considerations here, and MLPs are likely to provide higher volatility than the broader market. So it's important to keep that in mind as well. And just to wrap up, in terms of the trends within real assets, our views have been fairly stable over the past few quarters. A couple of things I'll highlight. So core real estate, that includes both private and REITs. But I mentioned earlier that there is maybe a slight disconnect in valuations, which is something we're going to continue to monitor. Infrastructure, you see we're neutral there, but I'd say really that could be broken out into a few different underlying strategies. So we're neutral on broad infrastructure, but we do think there are potentially some interesting opportunities within that space as well. Lastly, commodities, you see we moved from negative to neutral, so it's still not a buy signal. We're not quite ready to be positive, but we are seeing some improvements as over the past year or so, roll yields have become less negative, and the prospect of higher interest rates could also be a potential positive for commodities. So something to stay tuned on. And with that,
great.
Turn it back to Tim.
Thanks, Matt. And so thought I'd just spend a second here. I'm going to actually transition to Phil Nelson, our Director of Asset Allocation, to moderate questions. And I think we do have a few questions, but also wanted to remind everyone of our upcoming client conference, May 14th and 15th. We'd love to see as many of you as can join us. The theme of this year's client conference is disruption. So we're talking about some really interesting topics like demographics, artificial intelligence, factors that we think could disrupt markets and have profound impact not only on markets, but on all of our lives over the long term. So really excited and hoping that you can join us. With that, I'll turn it to Phil to take any questions that we have. And if we don't get to your question, we'll certainly follow up with specific answers for your portfolio.
Great, thanks, Tim. And if you do have questions as we're going through, some of the Q&A, feel free to keep on typing them into the question box. First question that came in is for Tim O'Connell and the equity group. With your comments on international small cap, is there a geographic concentration investors should be aware of, cognizant when kind of looking at this space?
So when we talk about kind of broad international, the biggest shifts going from large cap to small cap is that you pick up about 8 percentage points of Japan, which is kind of sourced from a number of other places, mostly Europe. And that really is the main geography that changes, but I think it's how that affects the underlying sectors. And again, this is at the index level. Active managers are going to toggle between Europe and Japan quite actively. You really lose a lot of financials, particularly European financials, which goes from about 21 to about 11%. That really shifts over to industrials, which is where a lot of the Japan exposure comes in. And that's at about 22% industrials from 14. And so those are probably the biggest changes you would see implementing through small caps compared to large caps.
Great, thanks, Tim. Why don't we take a moment with Dilawri on the credit side. It seems that relative to some of the other groups, there was more of a negative view broadly across credit. Maybe just take a moment and speak to is for some of the asset classes just more of a valuation view or concerns about the default cycle and where we are in that point?
Sure. So I think it varies based on which segment of credit we are looking at, but the answer is right. We are overall negative in a lot of segments of the credit area. If you look at IG, investment grade, the worry is more that if the rates keep rising, people have better options to move out to. So, the question is, are you still going to remain in your investment grade product with low yields or move out? And if a lot of funds move out of mutual funds, it creates a technical pressure on prices. So that's the potential headwind, which causes us to be a little nervous. It might not be just purely fundamental, but there is some aspect to at what price funds will have to trade out at to pay out redeeming investors. In the high yield sector, though, it's a completely different story. We are worried about the yield and what you're getting paid for the fundamentals in some sectors. There is some element to defaults being low. We are not anticipating or expecting that there will be a steep decline or a steep rise in defaults. That's not just the main concern for the negative view, but from a risk-adjusted perspective, getting paid 4% on a triple C debt is really not appealing from a risk-return perspective. We do think that the tax reform will help the high-yield sector a little bit. Other than triple C, most of the other high-yield segment that pays on average 28% tax rate will get a good break when the tax moved from 35% to 21%. That will be a huge saving, and that will be some tailwind. But for triple C segment, specifically within the high-yield segment, we are extremely nervous. The debt burden on some of those issuers is not enough to, kind of give them any kind of relief from just the pure reduction in tax rate. When you compare that with the limitation on the interest deductibility, it kind of tilts the scale in the latter and kind of affects the triple C issuers more. So we think that within the high yield segment, it will be fragmented, but triple C is one area that we remain nervous about, both fundamentally, but with the tax aspect further downgraded. I think in the CLO space, we still like the segment, but if you just look at purely bank loan segment, we are not negative, but we are neutral, and that neutral sense comes from the fact that some of the loan market is trading at or above par in some cases. Cov-lite loans have increased significantly in the last 5 years. So, when we put everything together, there's nothing overly to be exciting about. There is no passive beta that you can just capitalize on and expect to make a decent yield on. Credit selection is something that is very important, and diversification is the other aspect that we think will help.
Great. Thanks, Dilawri. Fair number of questions coming in kind of related to real assets. So Matt, kind of two questions that we can do a little bit of a rapid fire on. First is, roughly what are cap rates in the core real estate space today? And how does the 10-year Treasury hitting 3% maybe impact kind of views on cap rates going forward?
Sure. So cap rates, the short answer is it depends. They're generally in the 4 to 5% range, but certainly property type, location, are you major market, secondary market, or downtown asset, et cetera, all those things will affect cap rates. So there's not one single answer, but generally in the 4 to 5% range. I would say that the expectation of increasing interest rates is somewhat priced in. You saw on the chart I showed earlier that asset appreciation has been slowing basically since the second half of 2016. So that's a pretty long time frame of slowed asset appreciation, and that implies likely a softer landing, if you will, rather than some hard spike downward. I think the risk really is more in if there's any sort of unexpected sharp increase in interest rates. I think the Fed's been pretty transparent, signaling what's going to happen, and investors have acted in response to that, so it's somewhat priced in.
Great. And then second question, related a little bit, to how private equity investments and MLPs come together. How does, private equity investment in energy space, and that's clearly evolved over the last couple of years. Maybe touch on that for a moment, then also B, how is that impacting the opportunity set for MLPs today?
Sure. So in terms of energy private equity, I think in general, you're right, you are seeing an increase in capital being raised by energy private equity firms. We still think there's an opportunity there for the public companies. It's still been pretty hard to raise capital. They don't want to issue equity because their equity prices aren't very attractive, and debt financing isn't widely available. So we still think there's a good opportunity to be a private investor in energy. As it relates to MLPs specifically, I would say that the vast majority of energy private equity capital that's been raised is really focused more on upstream assets. That, if anything, is a positive for the midstream sector because more capital in the upstream sector means more drilling, means more production, means more demand for midstream. You may see an uptick in acquisitions of whether it's single assets out of an MLP or complete take privates of MLPs. You could see that happen from maybe an infrastructure fund, or there are a couple of specialist midstream energy managers, as well as some of the larger energy PE shops have a bit of a more diversified mandate. So I think of those groups, you might see an increase in activity, but most of the capital is targeting upstream. I think that, the ripple effect, if there are any, of some of those groups buying into the midstream, buying on the private side, buying into the midstream sector, if anything, that should start to change the sentiment of MLPs.
Great, thanks, Matt. And with that, there's a couple questions that we still have outstanding. We'll circle back with you all and touch base on those. But, Tim will have a couple comments to wrap up now.
Great, thanks, Phil, and thank you to all of you for joining us. Everything we do at NEPC is about putting clients first and doing the very best that we can for clients. So hopefully, sharing our views with you today fits into our overall work with you and our overall efforts to help you meet your long-term objectives. We will be posting this slide deck and a replay of the webinar to our website. So to the extent there's others in your organization that would benefit from listening to this, you'll be able to pass it on. But thank you again for joining us. We look forward to continuing to partner with you, and we hope to see you at our client conference. Thank you.